Hello everyone and welcome to Moementum channel. My name is Mo, and in this video we're going to be talking about two high quality dividend paying stocks that are currently considered to be reasonably valued, and they have a dividend yield of over 4%. Without any further ado, let's get into it. All right, our very first pick is a Canadian company called Canadian Natural. Although this is the Canadian business, it is available to investors outside of Canada with ticker symbol CNQ in US dollars. It's an energy, oil and gas exploration and production business with a dividend safety score of 70, making it a safe dividend payer. CNQ currently has a dividend yield of 4%, and it was last traded at the price of $62 in the stock market in US dollars. From a market capitalization perspective, Canadian Natural has a market cap of $67.5 billion, making it a large cap size business. It's worthwhile mentioning that last time that Canadian Natural increased its dividend goes back to November of 2022, where they increased their dividend by 13%, suggesting a very fast dividend growth. From a volatility perspective, Canadian Natural stock has a beta score of 0.78, which given that it's less than the beta 1, suggests a lower level of volatility than the overall stock market. If you look at their key metrics from a dividend perspective, Canadian Natural currently has a payout ratio of 23%, which is considered low for oil producers. However, the forward payout ratio for their dividends is at 32%, which slightly edges higher for oil producers. However, they do have a long history of paying and increasing their dividends. In fact, if you look at their dividend history, they have been paying their dividend uninterrupted for the past 20 years. And in all of those years, they've increased it year after year. But look at how they've been managing to increase their dividend very rapidly over the past 5 to 6 years. In fact, over the last 5 years, they have increased their dividend on average 16% per year. And over the last 20 years, they have increased their dividend on average 20% per year. All of them suggesting a very fast dividend growth. In total, Canadian Natural does pay their dividend coming to a value of $2.48 in US dollars. This dividend is divided almost equally and paid on a quarterly basis. And their dividends are paid in the months of January, April, July, and October. It's worthwhile mentioning that this business did pay out a special dividend for the amount of $1.50 Canadian back in August of 2022. From a timeliness perspective, Canadian Natural has its dividend yield currently very much in line with their own 5-year average, as well as their price to earnings ratio, which is currently sitting at the ratio of 8.1 for their forward PE, sitting slightly less than that of their 5-year average of 10.6, all of which suggesting the stock appearing to be reasonably valued. Looking at the forward price to earnings ratio for Canadian Natural and comparing it to that of the energy sector, they are at a lower multiple. In terms of the past 1 year price range for CNQ stock, the lowest that this stock price had hit was at $38.61, and the highest price for this stock in the past 1 year was at $68.78. We're going to take a look at a number of additional financial metrics to better assess this stock from a fundamental perspective and different financial measures. The first thing for us to look at is the earnings per share. Ideally, we'd like to see a business that continues to have a positive earnings per share, and in fact, their earnings per share continuously growing. You do see that in 2 years, one during the pandemic year, as well as the other one in 2016, they had a negative earnings per share. But other than that, in the past 10 years, they are being able to have that positive and growing earnings per share for the most part. It's slightly inconsistent though. You do see between 2012 to 2014, they had their earnings per share growing. Then suddenly in 2015, they had a decline. The next year, they had a negative. And then from there on, they managed to recover. 2020 was an odd year. But ever since in 2021, they had the highest earnings per share in the past years. And in the last 12 months, they've knocked it out of the park with earnings per share of $11.40. For the next 12 months, they're estimated to have earnings per share of $10.40. Next thing for us to take a look at is the total sales. That's the total revenue for the business, which is here reported in $1 billion. In 2021, they had a total revenue of $30.1 billion, which was the highest compared to the previous 9 years. And in the last 12 months, they have shown a $41.8 billion in total sales, which is just remarkable. The other financial metric for us to look at is shares outstanding. In here is reported in terms of billion. Ideally, we would like to see a business that buys back its own shares, gives more value to investors. And in this case, although that's not the case, we do notice that the issuing of the new shares is not as rapid, and it's fairly stagnant. The business has been able to maintain its number of outstanding share between that 1.1 to 1.2 billion outstanding shares. With that, we're going to take a look at Simply Wall Street to better assess the valuation of this stock. And this is looking at the CNQ in US dollars. As we talked about, the price to earnings ratio that they have, around that 7.5, 7 to 8, is, you notice compared to their peers, is a much better spot. Some of the peers that are listed here, Devon Energy is at 7.2 price to earnings ratio multiple. And then Canadian Natural Resources is much better than the other ones that are listed here, including Pioneer Natural Resources, EOG Resources, and Hess. The other aspect for us to take a look at is in terms of their price to earnings ratio compared to their price to earning for the fair ratio. What would that be? The fair ratio would have been more so around 9.1 multiple. And the fair stock price would be at $81.80 in US dollars. That's something for investors to take into account. This is based on Simply Wall Street analysts and based on the use of a discounted cash flow model, suggesting this stock at this price is undervalued by 25.5%. We're going to next take a look at analyst estimates for the price target in 1 year and where they see this stock heading. There are 9 analysts on tip ranks covering this stock, with 6 of them having a buy rating and 3 of them having a hold rating, giving the stock an overall moderate buy. Of these analysts covering the stock, the lowest price target here is estimated to be at $58.40, the highest being at $71.88. Based on all analysts' kind of predictions combined, the average price target is at $66.06. And if that holds true, given the last trading price for the stock, that shows an upside of close to 7% for this stock. This is not taking into account, of course, you are collecting the dividend of upwards of 4%, close to that 4% from holding this stock in this matter. Next, we're going to take a look at analysts on Yahoo Finance. They have a price target of $71.78. You notice in the last trading day, this stock was up by close to 1.6%. Moving on, we're going to take a look at another pick, and this is again another Canadian business. It's a integrated telecommunication services business called TELUS. Although this business is available for Canadian investors with ticker symbol T, it is available also for investors outside of Canada in US dollars through a New York Stock Exchange with ticker symbol TU. It has a juicy dividend of 4.56% and a dividend safety score of 72, marking it a safe dividend payer. They last increased their dividend by 7%, and the last trading price for the stock was at $22.44. Look at what such a massive return that the stock had in the last trading day. It was up by 3.4% in one trading day. Just incredible. TELUS has a market cap of $31 billion, making it a large cap size business. And for investors who are interested in passive, reliable dividend paying, this might be a great option, given that this is also a low volatility stock with a beta of only 0.55. They have been paying their dividend for the past 19 years, and in the last 18 years of those, they have increased their dividend year after year. You'd see here the dividend growth history. The last 5 years, they have increased it by average of 7%. And in the last 20 years, they've increased it by average of 7% as well annually. In terms of their payout ratio seems to be quite high, with 106% currently and 103% forward payout ratio. However, TELUS has continued to prove to be a reliable dividend payer. The history kind of attests to that. They have been paying their dividend for the past 19 years, as we alluded to earlier. And look at how their dividend amount is. Currently, they have a total annual payout of $1.02. They do pay their dividend quarterly in the months of January, April, July, and October. This stock is showing to be reasonably valued. First and foremost, their dividend yield of 4.56% is in line with their own 5-year average, which shows to be at 4.6%. What's more, their forward price to earnings ratio of 22.7 is higher than their 5-year average of 18. That might be a slightly of a red flag because they are trading at higher valuation compared to what the market has treated them over the past 5 years. However, it's worthwhile mentioning that their stock price is still not at the highest level that it had hit in the past 1 year. It was at $27.40 at the highest amount and $19.26. Something for investors to be mindful about. Maybe you might want to add TELUS to your watch list and keep an eye on it. Or if you want to start having a position in this stock, do it in multiple steps and don't necessarily buy and put all your money buying this stock in one go. That might be perhaps a wiser approach to adding this portfolio, this stock to your portfolio. In terms of earnings per share, they are showing nice increases year after year. As you notice here, how that has been transcended. 2020 and 2021 were 2 years that they had their earnings per share kind of being impacted. They show some decline, but in the next 12 months, they are showing definitely some signs of recovery with $1.34 in earnings per share. Next, we're going to take a look at their total sales. They're showing that nice, steady, gradual increase, almost like a picture perfect revenue story and situation for TELUS. In terms of their outstanding shares, they did have some shares buyback during the middle of 2016, 17, and 18. However, since 2020, they started issuing back shares. Now they have 1.39 billion outstanding shares, which is the highest level that they've had in the past 10 years. Moving on, we're going to take a look at their valuation from data based on Simply Wall Street. And you'd see here definitely what we pointed out earlier. They have slightly higher that price to earnings ratio compared to some of their peers, such as AT&T or Verizon. Definitely much higher, almost 3 times the price to earnings ratio. And if you compare that to that of IDT, they are in a better spot, with IDT having a price to earnings ratio of 24.6. Now, investors might be asking, why would you be paying such a high valuation for TELUS when you can get your hands on Verizon and AT&T at much lower valuation and much lower, the price to earnings multiple? One of the key reasons investors seem to be more bullish and much more willing to pay higher premium for stocks such as TELUS is the fact that TELUS is growing rapidly. You saw how they've been managing to increase their dividends so quickly year after year. They have a lot of growth potential ahead of them, whereas companies such as AT&T and Verizon are a little bit more established in there, and their growth potential are much more limited in this sense, and that's why they are traded at much lower valuations when it comes to price to earnings multiples. Lastly, we're going to take a look at the fair valuation for the stock based on the use of a discounted cash flow model and the estimates here. According to analysts here on Simply Wall Street, the fair valuation for the stock would be at $53.50, and that shows this stock, if that is true, it's in fact undervalued by close to 59%. That's a massive discount you're getting at this current valuation for the stock. Moving on, we're going to take a look at the analyst estimates on TipRanks. There are 9 analysts covering TELUS stock, with 7 of them giving it a buy rating and 2 of them giving it a hold rating, suggesting a strong, in fact, buy for the stock with an average price of $25.29. And if that holds true, that is an upside of 15.5%. And analysts on Yahoo Finance have fairly similar estimation, with them having a 1-year price target of $25. Hovering around that similar upside of 15%. There you have it, folks. We had a quick look into 2 high-quality dividend-paying stocks with dividend yield of 4% or more that have been paying their dividend for close to 20 years or so. And they are wonderful options for dividend investors who are looking for reliable passive dividend income to consider to add to their watch list, or potentially if they see that this is a good fit for their portfolio, add it and pull the trigger and buy these stocks. Of course, please make sure to do your own research before buying these stocks or any other stock that is talked about here on YouTube. I hope you found this video beneficial and you gained something of value from it. If you did, don't forget to smash that like button and subscribe to our channel. Here on Moementum Finance, we post every week several videos about investing, including investing in dividend stocks, growth stocks, penny stocks. We also talk about investing in real estate and ways to reach financial freedom. Thank you, and I hope to see you all next time.